Do you know that in 2007, a Lebanese-American statistician and former options trader named Nassim Nicholas Taleb published a book that fundamentally changed how many serious thinkers and investors understood the nature of risk? And that the central argument of that book, The Black Swan, was not that rare events are unpredictable, but that we systematically and catastrophically underestimate both their likelihood and their consequences, and that we construct elaborate narratives afterward to make them seem like they were inevitable all along. The Black Swan was published in April 2007. Within 18 months, the global financial system had experienced one of the most severe crises since the Great Depression. The events of 2008, the collapse of the subprime mortgage market, the failure of Lehman Brothers, the near collapse of the global banking system, the largest peacetime government intervention in financial markets in history, were precisely the kind of event that Taleb had argued the financial industry's risk models systematically failed to anticipate. The book about rare catastrophic events was followed almost immediately by a catastrophic rare event. Taleb had not predicted 2008 specifically, but the framework of the Black Swan described exactly why 2008 was possible and exactly why the people who should have seen it coming did not. This video is an exploration of Taleb's ideas in the Black Swan and what they actually mean for anyone trying to understand risk, build wealth, and think clearly about a world in which the most consequential events are the ones that models and forecasters systematically fail to predict. It is not a summary of the book. It is an application of the framework to the practical questions that matter most. How to think about what you do not know. How to structure your financial life in a world where catastrophic surprises are not only possible but, historically, routine. And how to use Taleb's insights without becoming paralyzed by the uncertainty they describe. This is for educational and informational purposes only, and is not financial advice. The Black Swan metaphor that gives the book its title comes from the discovery that changed ornithology and, metaphorically, epistemology. For Europeans, before the 17th century, the black swan was a definitional impossibility. Every swan that every European had ever seen was white. The proposition, all swans are white, had been confirmed by literally every observation ever made. It was not merely a hypothesis, it was the kind of statement that seemed to approach certainty through the sheer weight of accumulated confirming evidence. Then, European explorers reached Australia, and they found black swans. The discovery did not require complicated reasoning. It did not require elaborate refutation of the white swan hypothesis. It required only one observation of a black swan to demonstrate that all swans are white, confirmed by countless thousands of white swan observations, was simply wrong. The accumulated weight of confirming evidence was irrelevant the moment a single disconfirming instance appeared. Taleb uses this as a metaphor for a class of events that share three properties. First, they are outliers. They fall outside the range of normal expectations because nothing in the past definitively points to their possibility. Second, they carry an extreme impact. Third, in spite of being outliers, human nature makes us concoct explanations after the fact, making the event appear, in retrospect, explainable and predictable. The third property is, for Taleb, the most insidious. The retroactive narrative that explains why an event was inevitable, why the signs were there all along, why anyone should have seen it coming. This narrative is constructed after the event by our pattern-seeking minds. It feels like insight. It is, in most cases, a rationalization. And it makes us falsely confident that we understood what happened, which prepares us badly for the next black swan, which will, by definition, come from a different direction. The core intellectual framework of the Black Swan distinguishes between two statistical domains that Taleb calls mediocristan and extremistan. Mediocristan is the domain of quantities that behave according to the normal distribution, the familiar bell curve, where extreme outcomes are exponentially rare. Human height is a useful example. If you gather 1,000 randomly selected people and measure their heights, you will find a distribution clustering around the mean, with very few people significantly shorter or taller than average. The tallest person in the room might be 2 or 3 standard deviations above the mean, but no single person's height will dominate the aggregate. The distribution of outcomes is constrained by physical limits. Extremistan is the domain of quantities where a single observation can dominate the entire aggregate, where the distribution has what Taleb calls fat tails, meaning that extreme outcomes are far more common than the normal distribution would predict. Wealth is the clearest example. If you gather 1,000 randomly selected people and measure their net worth, the wealthiest person in the group might have more wealth than all the others combined. Financial returns, book sales, social media reach, pandemic casualty counts, all of these live in Extremistan. A single event, a single stock moving, a single book catching on, a single pandemic can dwarf everything that came before it. The problem, Taleb argues, is that human beings, including highly educated professionals whose job is explicitly to model and predict, routinely apply mediocristan thinking to extremistan problems. They use models calibrated on historical data to estimate the probability of extreme events. They use the normal distribution to describe the returns of financial instruments that do not, in fact, behave according to the normal distribution. They calculate value at risk, the measure that tells you the maximum you are likely to lose on any given day with 99% confidence, using methods that assume normal distributions and therefore systematically underestimate the probability and severity of extreme losses. This is not incompetence. It is a systematic bias, a feature of how human minds construct models of reality, and a feature of the institutional incentives that reward practitioners for producing precise-looking forecasts even when precision is not actually achievable. One of Taleb's most important contributions in The Black Swan is the concept of the narrative fallacy, the tendency of human minds to impose story structures on sequences of events, creating the illusion of understanding where only observation actually exists. We are story-building machines. When we encounter a sequence of events, we do not simply record them as a list. We impose causal structure. This caused that, this was the consequence of that. We identify protagonists and antagonists, turning points and resolutions. We construct a narrative that makes the events legible. The narrative fallacy is not simply a flaw in human thinking, it is adaptive. Stories are far easier to remember and transmit than lists of unconnected facts, and the ability to construct causal models of the world is part of what makes human intelligence powerful. But it becomes a source of systematic error when the narratives we construct are more coherent than the reality they describe, and when the coherence of the narrative makes us falsely confident that we understand the causal structure of events that we have merely observed. In financial markets, the narrative fallacy operates in several specific ways. After a market crash, analysts construct compelling narratives explaining why the crash was the inevitable result of identifiable prior causes. The narrative is usually plausible. The causes they identify were real, but it typically omits the many cases where similar causes existed without producing a crash, and it attributes more causal weight to the identified factors than is actually warranted. The crash in the narrative appears inevitable. In reality, it was one of many possible outcomes of a complex system. Before a crash, analysts construct equally compelling narratives explaining why current conditions are sustainable, why the identified risks are manageable, why historical comparisons are not relevant to the current situation, why this time is different. These pre-crash narratives are the mirror image of the post-crash narratives. They impose excessive coherence on a complex situation, they give false confidence, and they fail precisely because the Black Swan, by definition, falls outside the range of the narrative. Taleb's critique of prediction is one of the most controversial and intellectually challenging aspects of the Black Swan. Most financial and economic prediction is, Taleb argues, largely useless for the purposes it is presented as serving. Forecasters, economists, market strategists, analysts produce precise numerical predictions with apparent confidence. They cite historical patterns. They use sophisticated models. They display charts showing extrapolations of past trends. They appear to be experts whose expertise is the ability to predict future outcomes. The evidence for the accuracy of these predictions is, on systematic examination, not impressive. Studies of economic forecasting have consistently found that the accuracy of professional economic forecasters is not substantially better than simple extrapolation of current trends, and that their predictions of recessions, market turns, and other significant changes, precisely the events that would be most useful to predict, are consistently poor. Studies of financial analyst predictions have found similar results. Analysts systematically overestimate the precision with which future earnings can be predicted, and their predictions of extreme outcomes are systematically wrong. The reason, Taleb argues, is that forecasters are operating in extremistan with mediocristan tools. The models they use work tolerably well for ordinary conditions, the near-future extrapolation of current trends, and fail precisely when the conditions change abruptly, which is to say, precisely when good prediction would be most valuable. This does not mean that all planning is futile. Taleb is careful to distinguish between prediction, trying to forecast specific future outcomes, and preparation, acknowledging the range of possible futures and ensuring that you can survive the bad ones. These are different activities. Prediction aims at knowledge of what will happen. Preparation aims at robustness to what might happen. For the individual investor, the Black Swan framework has specific and practical implications that go significantly beyond the general advice to diversify. The most important application is what Taleb calls the barbell strategy, a heuristic for managing exposure to extremistan in a way that does not require the ability to predict which specific black swan will arrive. The barbell strategy involves holding the majority of your portfolio, Taleb suggests around 80 to 90%, in extremely safe, low-return assets. Short-term government bonds, cash equivalents, assets where the downside is essentially zero. The remaining 10 to 20% is placed in extremely high-risk, potentially high-return assets, where the maximum loss is 100% of the position, but where a black swan event in your favor could produce extraordinary returns. Options, venture capital, speculative positions in assets with convex payoff structures, the kinds of investments where you can lose your stake, but where the upside is theoretically unlimited. The barbell is explicitly designed to avoid the middle of the distribution, the assets that appear moderately safe, but are, in fact, exposed to fat tail risk without the offsetting potential for extraordinary upside. The classic examples of the middle, the assets that feel safe but are actually in extremistan, are financial instruments that produce consistent modest returns in normal conditions and catastrophic losses in tail events. Certain mortgage-backed securities before 2008, certain corporate bonds, certain hedge fund strategies that systematically sell volatility. The intuition behind the barbell is that in a world where black swans occur with significant frequency, exposure to extreme downside is the primary risk to manage. An investor who loses 90% of their wealth in a single tail event and who had no convex upside to offset it is in a dramatically worse position than an investor who earned modest returns across normal conditions and a spectacular return in one tail event that more than compensates for the premium paid to hold it. The epistemic humility that Taleb demands of the reader of the Black Swan is, in its application to personal finance, both bracing and liberating. Bracing because it requires acknowledging that the frameworks most of us use to think about our financial future, the projections of expected returns, the risk models, the financial planning spreadsheets, are built on assumptions that are vulnerable to black swan events in ways that the spreadsheets do not capture. A retirement plan built on the assumption of a specific average annual return projected across 30 years, does not account for the possibility of a sequence of extreme negative years early in the drawdown phase that could exhaust the portfolio before the average has a chance to reassert itself. A diversification strategy built on historical correlation between asset classes does not account for the possibility that correlations break down precisely during the crisis, when diversification is most needed, as they did in 2008, when assets that were supposed to be uncorrelated fell simultaneously. Liberating because it frees the investor from the obligation to pretend that they know what they do not know. The honest position in a world of black swans is not to claim predictive ability you do not have. It is to structure your financial life so that you can survive the tail events you cannot predict, and to remain positioned to benefit from the positive tail events that are equally beyond prediction. This means maintaining liquidity, having resources that can be deployed when extreme negative events occur, rather than being fully committed to positions that must be liquidated at the worst possible prices during a crisis. It means avoiding leverage, the amplifier of black swan losses as well as of ordinary returns. It means being skeptical of any financial product or strategy that produces consistent modest returns with apparently low risk, because in Extremistan, that profile often means hidden tail risk rather than genuine safety. And it means holding, as Taleb does, a deep and genuine respect for what you do not know, which is, always and inevitably, more than you think. The Black Swan was published in 2007, and the world almost immediately demonstrated its thesis. The 2008 global financial crisis, with its cascading failures, its revealed hidden risks, its triumphant pre-crash narratives, followed by devastated post-crash reality, was the largest illustration of Taleb's arguments that could have been designed. Financial models that said the events of 2008 were essentially impossible could not prevent them. Risk managers who had calculated their exposures with sophisticated precision were exposed to losses their models had said were inconceivable. And in the aftermath, the narrative-building machinery of the financial press and the academic community explained why, in retrospect, 2008 was entirely predictable. Precisely the retroactive narrative construction that the Black Swan had identified as one of the primary sources of our vulnerability to the next crisis. Taleb has continued to develop his ideas in subsequent books. Anti-Fragile explored the concept of systems that not only survive black swans, but benefit from volatility and disorder, the opposite of fragile. Skin in the Game argued that people whose advice and predictions carry no personal cost, consultants, economists, financial analysts, are systematically incentivized to produce confident predictions without the accountability that comes from having actual money at stake. These extensions of the Black Swan framework share a common thread: the conviction that the most important questions about risk, prediction, and decision-making are the ones that our standard frameworks are worst at answering, and that the gap between what our models say and what reality produces is not a minor calibration problem, but a fundamental structural feature of complex systems operating in Extremistan. The investors and decision-makers who have taken this seriously, who have internalized the Black Swan framework rather than simply reading it as an interesting argument, have in many cases structured their financial lives and their decision-making very differently from the norm. Less leverage, more optionality, more respect for what is not known, more preparation for tail events, and less reliance on central case predictions. This is not a comfortable way to think. It does not produce the satisfying precision of a detailed financial plan with specific projected outcomes. But it is, in Taleb's view, and in the view of the evidence he marshals, considerably closer to an honest reckoning with the actual nature of the world in which financial decisions are made. A world where the most important events are the ones that fell outside the model. The Black Swans are real. They have always been real. The question is not whether they will come. The question is whether you will be positioned to survive them when they do.